Good morning. Welcome to Market Monday. Well, this Wednesday, the Fed will wrap up its July meeting, where it's widely expected to raise rates by another 0.25%. You may recall the fanfare around last month's meeting where the Fed decided to pause raising rates. Or was it a skip? And despite one of the fastest hiking cycles in history, the market has seemed to power through all those black clouds that caused many folks to scream recession over the past year. Yield curve inversion, negative earnings growth, debt ceiling, Fed hiking cycle, inflation, money supply, you name it. It was all supposed to bring imminent recession. Even house prices, mortgage rates, nobody selling their homes. In the most recent NAHB, National Association of Home Builders survey, it appears home builder confidence increased in July. Remember here when everyone said, so goes housing, so goes the economy, as yet another imminent recession indicator. I wonder what they'll say now. Indeed, the market has had a great start to the year so far. In fact, one of the best through the first 135 trading days ever. There's 2023 right there, up over 18%. And we see the return for the remainder of the year. Some major outliers here, like 1929, 1933, and some of you may remember Black Monday in 1987, where the Dow fell 20% in one single day. And 2023 could be another outlier, no guarantees. But more often than not, strong starts continued through the rest of the year, producing these full year returns over here that are quite strong. Of course, if you've been watching Market Mondays for more than a few weeks, you know a common theme we preach is how sentiment follows price. Meaning as the stock market heads lower, folks become more bearish. And as the market rips, like in 2023, folks become more bullish. This is human nature, and it's probably the most reliable aspect of investing, which makes it so challenging. This can be seen in any of the AAII surveys we show, but not so fast. Human emotions aren't just reserved for individuals. Professionals, wealth advisors like ourselves, fund managers, we're all human, last time I checked, which means we're all susceptible to emotions inherent in investing. Case in point, here's a recent Bank of America survey of fund managers, asking what's the most likely outcome for the global economy in the next 12 months. 2 months ago in May are the gray bars here. June is in light blue. And the most recent survey from July is in dark blue. As the market powered higher, more fund managers now believe a soft landing is the most likely scenario, and fewer think a hard landing is the most likely outcome. Or maybe it's Goldman Sachs chief economists reducing the odds that a recession starts in the next 12 months from 25% to 20%. Okay, what does that even mean? Folks, we gotta fight to keep our sanity here. You know, these headlines are being pushed on us all of the time. Soft landing, huh? Not so fast. How about a little balance and context? No, don't do it, Chad. Sorry, folks, it's our duty to you. Have a look at a couple soft landing calls over the past few decades. Look at this one from 1989, 27 economists. Oh, they must know something. Predict a soft landing. Then the savings and loan crisis of 1990 and 91 happened. Or Fed Chair Greenspan in 1999 looking at a soft landing. Oops. And of course, former Fed Chair Ben Bernanke infamously calling for a soft landing in 2007, just 8 or 9 months before the market peaked and the ensuing carnage in the stock market in 2008. Admittedly, we would feel great if Fed chairs just came out and started calling for a soft landing. Something about that just makes us feel good. However, we know it really doesn't mean much, and we should continue taking everything anyone says with a grain of salt. Have a great week.